Imagine waking up and checking your retirement account and finding it down 30% before your coffee is even finished. There's no headline about war, no banking panic on the evening news, and no obvious scandal to blame. The cause is invisible and instant. Automated trading systems, running algorithms, and artificial intelligence execute billions of dollars of orders in milliseconds, and a chain reaction removes value from screens before a human can react. That scenario sounds like a thriller, but it is the exact kind of fragile reality markets face as machines take more control. The question isn't whether AI can trade, it already does. The question is, who survives the next crash? The humans with experience and judgment, or the machines that never blink? For most of modern financial history, markets were shaped by people. Traders relied on relationships, intuition, and pattern recognition developed over decades. The image of a bustling exchange floor captured a world where human judgment mattered, and slow, messy conversation sometimes prevented catastrophic groupthink. Then technology changed everything. Computers moved from number-crunching assistants into active participants. High-frequency trading, quantitative hedge funds, and AI models began to take positions based on massive amounts of data. Where a human once had seconds or minutes to decide, machines now act in microseconds. Past crises give us clues about how automation changes the math of risk. On Black Monday in 1987, rule-based portfolio insurance strategies were coded to sell as prices fell. When many programs executed the same rule at once, they amplified the decline into a global meltdown. That event showed how perfectly rational rules at the firm level can aggregate into catastrophe. In 2010, the flash crash demonstrated the next lesson. In a matter of minutes, major indices plunged and rebounded as automated programs traded with each other in feedback loops. Human traders could only watch. Knight Capital's 2012 outage is another example. One faulty deployment caused unintended orders and losses that nearly destroyed the firm. And during the early months of the pandemic in 2020, algorithmic and passive strategies contributed to a rapid evaporation of liquidity until central banks intervened with extraordinary support. These are not isolated curiosities. They are patterns that reveal how technological complexity changes failure modes. Artificial intelligence brings capabilities that are both impressive and dangerous. AI systems ingest thousands of disparate data streams, market prices across venues, order book depth, news headlines, social media sentiment, satellite images of cargo and inventory, macroeconomic releases, and hundreds of alternative signals. They analyze patterns, find correlations humans cannot see at scale, and translate those signals into trading decisions in microseconds. That speed and breadth improve price discovery and reduce trading costs in many conditions. But that same speed also means a shock can be amplified and transmitted globally before human oversight can intervene. Humans still bring essential strengths: judgment, skepticism, moral hazard awareness, the ability to infer incentives and read political nuance. These qualities matter when markets encounter novel scenarios that are poorly represented in historical data. Before the 2008 crisis, some investors recognized structural weaknesses in mortgage markets that many models missed, and they profited because they questioned the underlying assumptions. Humans can think creatively about incentives, regulatory shifts, and counterparty behavior in ways that are difficult to encode into a dataset. The systemic risk arises from interactions and homogeneity. Many firms optimize to the same performance metrics and tune models on similar datasets. When multiple systems are calibrated to the same signals, they can all act in the same direction simultaneously. That emergent herding is not malicious collusion. It is simply the result of similar optimization. When machines herd, they do so at machine speed. The result can be stampedes rather than careful rebalancing, producing discontinuous moves that overwhelm market makers and human risk managers. Different crash scenarios expose different weaknesses. In a flash crash, the opening minutes are dominated by algorithms. A cascade of automated sell orders can overwhelm liquidity providers, causing prices to gap and circuits to trip. Circuit breakers, regulatory pauses in trading, can slow the fastest moves and give humans time to assess, but they are not cures. Pauses can blunt immediate damage. Yet when trading resumes, the backlog of orders can produce further violent repricings if the underlying vulnerabilities remain. In a prolonged macro crisis, human judgment and policy response matter more. Long downturns require assessing fundamentals, corporate solvency, fiscal policy, and central bank intervention. Investors who can reason about these dynamics and hold through temporary dislocations may outperform short-term quant strategies that are not designed for extended stress. The most dangerous cases are hybrids. A rumor or bad data feed triggers human selling. Algorithms detect momentum and accelerate the sell. Humans react to the new prices and sell more, and the loop intensifies. That feedback loop can cascade across equities, bonds, currencies, and commodities in minutes, with global consequences. Concrete examples help make this real. Crypto markets, dominated by automated bots and thin liquidity at times, have shown repeated extreme squeezes and sudden collapses. Certain energy futures moved into negative territory in 2020 as storage constraints collided with automated positioning. Overnight currency gaps have followed sudden political psychological shocks when algorithms reacted before human investors could absorb the news. Knight Capital's outage is a sober reminder that one firm's coding mistake can become a systemic problem if many systems are correlated. Could AI stabilize markets instead of destabilizing them? In principle, yes. A well-designed system that prioritizes robustness could detect stress earlier and reduce exposures gradually, damping volatility rather than amplifying it. Models trained with adversarial scenarios, diversified across architectures, and constrained by conservative loss limits could act as shock absorbers. But incentives matter. Firms rewarded for short-term alpha and millisecond decision edges tend to deploy the fastest, most aggressive strategies. When many participants chase similar edges, model convergence increases systemic fragility. Regulators do have tools that can make a difference. Circuit breakers, minimum resting times for orders, mandatory pre-deployment testing of big algorithms, stronger model risk governance, and requirements for adversarial stress testing are practical measures. Exchanges can implement staged re-entry rules so that when trading resumes after a halt, orders are released in waves rather than flooding the order book. Regulators can require clearer audit trails and enforce kill switches so a failing system can be halted promptly. Cybersecurity is another critical dimension. Automated strategies depend on data feeds and alternative data that can be manipulated. An attacker who spoofs pricing feeds or corrupts news feeds could create false signals that trigger automated selling. Firms must protect data integrity with authenticated, redundant sources and rapid incident response plans that define who has authority to halt systems, how counterparties are informed, and how regulators are notified. Because markets are global, international coordination is essential. Exchanges, clearinghouses, central banks, and regulators in the United States, United Kingdom, Canada, and Australia need shared protocols for communication during fast events. Joint simulations and cross-border contingency planning can reveal vulnerabilities and improve preparedness. Central banks should run stress scenarios that explicitly account for algorithmic behavior, so policy buffers can be calibrated to modern market dynamics. What can investors and households do? First, diversify across asset classes and strategies. Avoid excessive leverage and maintain emergency liquidity so you are not forced to sell in a dislocated market. Review pension allocation and ask managers whether algorithmic strategies are concentrated and how those strategies are tested under adversarial conditions. Consider holding a portion of truly low correlation assets, such as long-dated government bonds or certain real assets that are less sensitive to instantaneous order book dynamics. Education matters. Understanding how circuit breakers, order types, and execution venues work can protect you in volatile episodes. For institutional investors and pension trustees, demand transparency and stress testing. Require managers to disclose algorithmic exposure, to run cross-asset adversarial scenarios, and to demonstrate operational controls, including rollback procedures and tested kill switches. Boards should make model risk governance a core oversight responsibility, rather than a checkbox exercise. At its heart, this is a governance challenge. Decisions about how much autonomy to grant machines, who bears legal responsibility when automated systems fail, and how to protect the public interest are political as well as technical. Policymakers must balance innovation with public safety, and that balance will determine whether AI becomes a tool that improves market resilience or a mechanism that accelerates and concentrates shocks. One final risk is an arms race among algorithms. When AIs try to predict each other's moves, they can trigger reflexive loops that spiral out of control, creating market behavior humans have never seen before. Subscribe for more deep dives into the forces shaping your money.